Hello and welcome to another episode of Angel Insights, the show that goes deep into the world of early stage investing. I'm your host, Tom Burton, co-founder of SyndicateRoom, and on today's episode, I'm delighted to welcome Simon Blakey. Simon's been an angel investor for over 25 years, has loads of experience and stories to share with us. In addition to that, he's chair of the investment committee at Playfair Capital, he's on the board of Cambridge Angels, and has sat on the board of many startups. Without further ado, let's bring Simon to the show. Simon, it's absolutely a pleasure to have you on the show. Thank you for joining us today.
Thank you very much indeed. It's great to be here.
Now, for those who haven't been listening to this podcast very long, we actually had your brother on the show many years ago. And I hope you don't mind me mentioning that when we spoke, you said, well, I hope we get more listens to this one. So a little bit of friendly rivalry between the two. But
of course. It's great, but we get on very, very well.
You studied something completely different than investing. I believe you trained to be a biochemist. Then you went on to going through the Chartered Institute of Management Accountants and moved into management consulting. And then you became the chairman of the Genius of the Violin Festival, all things which are great in their own rights. But how do you go through that transition and then become an angel investor? What led you to investing in startups?
Well, the Genius of the Violin Festival was actually after I started doing my angel investing, and it was incredible. It was three of us putting on 120 hours of live music events over 2 weeks in London, from the fundraising and everything else. But that was very much a side hustle on top of the day job. So when I was working as a consultant, my side hustle at the time was residential property development. And this was in West London in the 1990s. And I found that actually it was far more lucrative than actually being a consultant. And around 98, 99, I had kind of recognized, I was in my mid-20s at the time, that being a partner at a consultancy firm was not my life goal. But if you cast your mind all the way back then, it was the start of the dot-com boom Mark 1. And just angel investing was beginning to just be talked about. And I made a bit of money out of the property side of things. And I thought, well, why don't I go and try doing angel investing?
How did you get introduced to it? Because obviously, being a management consultant and doing property, they're quite different worlds to tech and startup.
It was a very, very different world, angel investing back then. It was very part-time. It was very, very hobbyist. I literally set myself up in a 2-person office in Regis in Hammersmith. Said, right, I'm a business angel investor. I went and bought books on how to do term sheets and corporate finance. I went around and I spoke to lots of people. But just before that, I had spoken to a really wise guy called Christopher Stone, who said, look, Simon, if you're going to try something like this, but do it full time or don't do it at all. And I thought, well, this is kind of understandable. Let's just commit to doing this, but don't rush into it. It was the height of the dot-com boom. Everyone was talking about the internet in the same way as everyone is talking about AI today. I thought there were a lot of hype deals around, but I really wanted to find what I call the unfashionable businesses with the unfashionable valuations, those kind of deep value type place. And so that's what I did. I took my time. I went slowly. I asked people lots of questions, but because the internet was in its nascent form, there was no forums for finding deals. You went to the business angel networks. There was a thing called Venture Capital Report, which was a nice green bound thing that came out, and it contained 2 or 3 deals with some very summary due diligence. And you went in and it was pay to pitch, and you looked at these deals and you decided, yes, I'll do that, or no, I wouldn't. And then every single legal document was bespoke, and putting together a £400,000 round was a real challenge. So
no seed legals back then.
There was definitely no seed legals. And even back then, we were having fights with the lawyers about fixed fees on legal documents. But I was very fortunate that I was introduced to a lawyer early on who taught me exactly what I should be negotiating and what I shouldn't. So I took it slowly, very much decided that we're going to do a couple of deals a year. You couldn't do it. The market didn't allow you to do the frequency of investing that you can now do because everything was so bespoke and the market was really, really in its infancy back then. And I was just very lucky. The first 5 deals I did all ended up in differing time periods being really good. And one of them was really good in just 18 months. And I thought, oh, this angel investing side of thing is easy. I was wrong. And I then probably had about 7 years where I look at my returns spreadsheet and go, every single one was, excuse my French, but that's a shite. It was, I look, but I'd had that initial success and quite serious returns in that early stage. And I kind of went, right, okay, well, I've just got to keep on working at this and things will come good in the end. And I now look at my portfolio and like, well, yeah, I have this valley of death, but actually in the end, it's all kind of come out
good.
Quite all right. Yeah.
We'll come on to that in a little bit, but if we can rewind a little bit, do you remember the first deal that you did? You said late 90s. So you've been angel investing for a quarter of a century now. That's incredible.
Yeah. Don't remind me. I absolutely do remember it. And in fact, I was emailed by one of the co-founders of that business, which is a robotics business, which we sold to GE Aviation a few weeks ago. And it was for £25,000. It was 350 or 400,000 pound round. We were doing it with a VCT. It was 2 founders in a garage down in Bristol making what they called snake arm robots. So where the body followed the head of the robot. It was really, really advanced for its time, which was kind of 2000 or so. It was one of those classic ones where it was a really cool technology, but we constantly struggled over several years trying to find the killer repeatable application for this technology. We did lots of bespoke work. They never raised further funding.
Oh, wow.
It was all paid for by customers, retained all the IP, but it was getting those repeatable robot cells. We initially started with doing work for the Department of Defense on bomb disposal. We did a quick foray into natural orifice surgery, which you can guess what that involved. And we mended a couple of nuclear reactors as well, because, pipes in nuclear reactors are not that easy to access by humans. But it wasn't until we reached the kind of aircraft manufacturing maintenance vertical that we actually really found some degree of repeatability. And the company, although we sold it, is still very much part of GE Aviation today.
Really cool. What was it about them that made you want to invest? Because early on, when you're angel investing, you're trying to figure out what it is you like. And you mentioned unfashionable kind of businesses. What was it about this particular one that made you write that check?
I wish I could say I had a great thesis back in 2000, but I really didn't know what I was doing. I think it does come down to a lot to the people. I'd spent a year speaking to a lot of entrepreneurs. I began to understand what I thought good actually looked like or bad. And I thought that the technology had a lot of different potential applications. The struggle, as I mentioned before, is actually working out what was that scalable application. But ultimately, and to this day, I do a lot of my pre-seed investing based on the domain expertise of the founders, which I think is really, really key. These were 2 academics who were well into the detail, and that slight degree of stubbornness and of obsession, I think, more than anything else, to run through walls to actually prove what they have got is a viable business.
I think I know the answer, but let's say you knew then what you knew now about angel investing and your thesis had developed to what it is now. Do you think you still would have written that check into that company?
Probably. That's a difficult one to answer, but possibly not, because I think now I would want a degree more focus and market validation from what they were developing before I wrote the check. Ultimately, it turned out absolutely fine for me as an investor. And actually, I really enjoyed the journey with that company, which I think we sold in the end in 2014 2015 or 2016 or something along those lines. But yeah, my little mental notes that I make when I'm assessing any deal has definitely, the checklists have definitely increased since those early days.
Definitely. The experience though, that was your first investment. And looking back on it, what were you expecting to get out of the journey, not financially? And what was the experience actually like for you?
I wish I could tell you I went into this with a huge grand master plan about how this was going to work. My plan, as far as it stood, was I'm going to try my very best at angel investing. I'm going to do it for 2 or 3 years. And I'm going to, if I feel that I'm finding some good deals and I'm getting some returns, well, great, I might continue it. I had not the slightest idea that a quarter of a century later, I would still be doing this as a job. But I think the thing I have learned is that I should have stuck to property development if I was just doing this for a pure financial return. I think you have to, in the sphere of angel investing, understand that you've got to enjoy the journey as much as the destination. So when you're assessing founders, actually really sit there and go, are these people I think I can work with over the next X number of years? Because life is too short to deal with. Well, I have a fairly blunt way of describing it, which you can imagine, but less than ideal people is probably what I'll say on a podcast.
Sage advice. Definitely. People talk about it. Investing is like a marriage because it'll last many years and you'll have ups and downs. So I think you've put it much more politely than.
And it's much easier to get out of a marriage than it is getting rid of a errant investor or even an errant founder.
We wanted to take a step back and we talked about the first one. Obviously, it's been 25 years. Roughly how many you made in that time?
So in total, I've done, I think, between 50 and 60 investments. I've done over 100 individual funding rounds at this stage. And I've got about half of those are in the portfolio, still in the portfolio. The oldest one is from 2002.
Wow. Still going.
Keep still going. Paid me multiples of my original investment back. And I tell David, the founder, that, an exit would be nice at some point. And I saw him a few weeks ago and he said, yes, this is the plan to do it. And it would be nice to bring this one to close. But it's been a successful deal. And the exit will be, I think, a very successful exit for me as well. So I'm not worried in the slightest.
How many of those investments that you've made that are still going, for laughs, said we plan to get an exit in 5 to 7 years? And
everyone wants to get an exit in 5 to 7 years. I was lucky or unlucky in the fact that my first successful exit happened after 18 months. So I thought that was kind of standard and normal. And that made a considerable amount of money for me. But, I've got one fantastic company in my portfolio. I was in Lisbon with them last week, which we invested in end of 2016, December 2016. For the first 4 years, it grew slowly. Then actually COVID was catalyst for some monumental growth. And now it's, 120 people. It's done over $1 billion of GMV. It's a big space and it's flying. But I'm 10 years into that journey or 9 years into that journey. And there's no plan on exiting it soon. Logistic business I invested in, buy box it, only took money from me and a couple of other angels back in 2001. We sold it in 2016 for 120 million again. It was a big exit, angel only, but that was 15, 16 years. So I'm very, very relaxed that the timings can be a lot more lengthy than you would expect. And that's where the fundamental difference, I'm going to segue. That's where a fundamental difference can happen between angel expectation and VC expectations, in that VCs need to have fast growth from the get-go, partly because if they aren't able to raise their next fund, then they are out of a job themselves. And the best way to prove their prowess as investors is to have an uptick in the valuation of the existing portfolio.
You sit on both sides because obviously you do your angel investing and you have Playfair. And you've obviously highlighted one of the differences being that time pressure, being the ability to raise that next fund. And with the angels, you can be more relaxed. Some angels are not necessarily more relaxed with investing. But what are some of the other differences that you see between your angel investing, say due diligence, and the VC due diligence? Because here, as an angel, you're investing your own money, your own time and capital, and on the VC side, it's other people's money, still your time. But how much does that impact the level of due diligence you do? Obviously, the stage is a little bit different because, well, you do at Playfair, you do seed and some later stage.
We do pre-seed and seed, pre-seed and seed.
So maybe similar there, but what other differences are there between the two approaches to investing?
Well, I think you have to be more structured and methodical in the VC side of things because you're managing other people's. As the team likes to tell me at Playfair, Simon, you're an IC of one when it comes to your own angel investing, and I've never been accused of being less than opinionated, and I will make a decision fairly quickly. So you have to be more structured. I think also you have to really think about the scale of returns, and this comes down to kind of market sizing. There's a lot of questioning and thought that goes around what is the scale of the market opportunity that you've actually got to. At Playfair, we sit there and go, can this be a 100 million ARR business? Can it be a fund returning business? Is there a big enough market, TAM, SOM, classic metrics that everyone talks about, that you can actually go after to see a route to 100 million exit? Now, you might need multiple rounds of financing to get there. So your percentage equity over those multiple rounds of financing becomes a really key consideration, and how can you defend your position? Up until moving to the dark side in 2019, I would say that, still 80 to 90% of my time is around angel investing. I didn't really think so much about the size of the market opportunity, whether this could grow to a huge fund returner type stage. And I don't think a lot of angels do. In fact, there is a really strong argument that we've been talking at Cambridge Angels about a lot recently is, are there kind of angel funded business or are there VC funded business? And actually, are they on two totally different tracks? Because if you can have an angel funded business that does a couple of rounds of funding and sells for 40, 50 million pounds, but you've got in at 1 or 2 million valuation, you as an angel are going to be very, very happy. The entrepreneur is going to be very happy, but a 40, 50 million exit for most VCs is really not going to cut it at all. So I think that's a kind of another slight subtle difference, as well as that timing side of things that you have to think about when you're comparing VC funding to angel funding.
You mentioned you joined the dark side in 2019, i.e. Playfair Capital, who are a great firm, to be honest. I know a few of the people there. In that time, you're year 6, going on year 7 with that one. Have you seen that your approach to angel investing has adjusted, given that you're being more methodical and looking at bigger markets on this side? Has that bled into your angel investing, or have you been able to still keep them as quite distinct investment committees and approaches?
Oh, yeah, yes, I have largely been able to keep them separate. I am really clear that there are some deals that I will do on the angel side. And actually, there's a deal I did at a medtech device end of last year, fantastic founders. And I showed it to Playfair, and Playfair, this is out of thesis. This is not what we touch. And therefore, I'm very comfortable doing this on my own. Do I take a more methodological approach? Possibly. I think I understand things a lot more clearly from what drives VC behavior and VC returns now that I wasn't aware of when I was acting purely with my angel hat on.
It's a fair answer. And maybe even if it was just subconsciously, there will be things that you've picked up through the different investment committee and individuals there. So I wanted to change track a little bit. You had this great post that you put on LinkedIn about a week ago. And in that post, the top line was, "Why do angels can crash and burn?" Which was a bit dark itself. For those that didn't see the post, I was wondering if you could share a little bit behind what led you to posting that.
Thank you. Well, I'm quite often introduced or know entrepreneurs who've recently exited their business, and it's a huge time of transition for them. I had lunch with one very successful one a few months back who told me that he actually spent a lot of time just watching Netflix box sets. He completely lost his raison d'etre, which is completely understandable. This is your third child, fourth child. This is your child, this company that you've just sold. So you've got money in the bank. You don't really have, if you exit completely, you don't have any job to do. And people look and go, oh, well, I'm an entrepreneur. I know what entrepreneurship should be. I know how to build businesses. I'm going to become an angel investor and put my money to work and share my experience with entrepreneurs who are just starting out on the journey. But what tends to happen is they jump straight in. They don't really know what good looks like from a kind of investment standpoint. So they might say, oh, I'm going to invest a lot of money in 2 or 3 deals, not remember that there's going to be a follow-on, try and get really involved in the businesses because they're a successful entrepreneur and the entrepreneur they've invested should be listening to them and doing what they say that they should do. And then suddenly the 2 or 3 either start needing to raise lots more money or, they one of them flames out, because your failures generally always happen before your successes show their successes. And then they turn around going, actually, this is difficult. I'm not enjoying this. I've just managed to lose a whole load of cash. And I just have kept on seeing that pattern again and again. And I want more successful entrepreneurs to be successful angel investors, but to also try and understand that the mindset that you bring to your angel investing has to be slightly different to that as an entrepreneur. First of all, you are the sage, wise counsel sitting on the side. You are not the person who is doing or getting involved into the operational side of the company. The fact that you will probably lose a load of cash because early stage is very, very high risk. I've learned far more from my failures than I have from my successes. The successes generally have happened without much despite me. The failures I have tended to get really involved in, and unfortunately they don't necessarily, even if it's a moderate success, they don't necessarily have a huge impact on your overall portfolio performance. And so it's about, they forget about follow-on. They forget about that you've got to learn how to do it. So don't just because you've got a load of cash in your business, in your bank account, suddenly decide that you've got to invest big because you're a successful entrepreneur. Start small. If people ask you how many deals you've done, don't feel as though you have to have done a load to be valid. Say that you're taking your time and you're waiting to find the right deal and you're building your network to find that right deal. Save money for follow-on. So I could go on. Sorry. So that's a long explanation of a brief LinkedIn post.
There's quite a parallel here with professional sports people. It's a funny one to make, but you see a lot of them, they retire, they miss it, they want to get back in the game and somehow. So they think, oh, I was great at this. I'm going to be a coach, I'm going to be the manager of a team. And no matter how good they were as a player, the skill set that allowed them to be a great player doesn't necessarily translate to being a great coach or a great investor in this case, as we've seen with the likes of, well, certain coaches. I don't want to put too many under the spotlight, but they go straight into a big job, fail miserably, and kind of never get out of that. I think Wayne Rooney is probably one of those examples where, great player. It's time will tell if he's going to become a great coach, but he went straight into coaching, probably didn't spend enough time learning the art form of coaching, and has had some successes and quite a few more failures on the coaching side. I do think he will probably come good, just in case he's listening.
Yeah.
He was a brilliant player.
Picking up some
Sorry, Wayne, if you are listening.
Yeah.
But it does take time, and you have to change your mindset and understand it's not me anymore, and I have to find a way of inspiring them or mentoring them to be a success.
Yeah, it's a lot of what you do is quite subtle, and as an angel investor, you will almost always have a minority position on the cap table. You quite often will not have legal rights to enforce a position. So what you have to do is gently give explanation and rationale and guidance as to how to do things, rather than in this CEO mindset, or I've been leading a company mindset, which is I say do this and it gets done.
Definitely agree with that. What do you think is the hardest part then about angel investing that someone who's newer to it should know?
I would say it's safe to say there are three aspects to doing angel investing, and only one of them is the fun bit. The deal sourcing, nobody likes to do. You can go for months and you can not see a deal that looks good. And I remember quite clearly back in 2007, 2008, I went for 18 months with not doing a new deal. So for every one deal that you find, you might see 50, 100 deals that just don't look good. Being relaxed about that process is kind of key to your, am I an angel or not? And I think we've touched on it earlier in the fact the length of time that it actually takes to show success in a business. It can take years. I've got one company in my portfolio which invested 2 years ago. I got the quarterly update and had a conversation with the founder the other day, an IoT business. It was him and his CPO. It's taken 2 years to get to the point where we're really beginning to show some commercial traction and lots of pilots happening. He wants to run fast, and I'm much more relaxed that it's going to take a long time. And he's structured the business in a way that means that he's not burning cash unnecessarily until he's got that commercial traction. The third bit is the post-deal process, where hopefully the founders can show their full potential, and you can, in whatever way you can, help and advise them on that journey.
And for that part of it, for someone who's newer to angel investing, how much of it should be proactive versus reactive?
I think it depends whether or not you are leading a syndicate or you are one part of a syndicate and not a lead. At one stage, I was on 13 boards. That was one of the worst times in my angel investing career, because if you're on 13 boards plus trying to do new deals, there's always something going wrong.
Did you sleep?
Not a lot. I remember an awful lot of midnight, 1 o'clock end times, and me telling my brother, I'm just not enjoying this. This is in no way pleasurable whatsoever. So I find now the way that it works for me is I tend to avoid joining boards. I will if it's particularly necessary, but generally it isn't. But I do want to be on WhatsApp with founders, and I do want to build up that level of trust between myself and the founder that they know they can come and speak to me about anything that happens. And I've had founders admitted says to me, I've had founders telling me that they're having mental health issues or the fertility issues, all the rest of it. So it's about being that sounding board over and above just the financial performance of the business, because I do say that angel investing can be a lonely business, but equally as well, I think being an entrepreneur and growing a business can be equally isolating and lonely, and not many people know the pressures and strains that you're going through as part of that.
No, completely agree with that. 3 quick questions then to wrap it off, because you've been absolutely fantastic with your time and insights. So first, what's the best resource for angel investing that you've been able to tap into along the way?
Other angels. You don't quite recognize, and I certainly didn't recognize at the beginning, how isolating it can be being an angel. So I would urge anyone who is starting their angel investing journey to reach out to other angels, join an angel syndicate, ping me on LinkedIn and just go, I'm thinking about doing this. What should I think about doing? So me being part of angel networks, having other angels I could just speak to about doing deals, do a sense check on whether what I'm thinking is right or wrong, is really, really valuable.
Question number 2, are there any rules that you previously had in place that you changed your opinion on when it comes to making investments?
Yes, and actually there's one that has come out through the data that I've seen in my own personal portfolio, which is I generally don't do more than 2, maximum 3 investments into any one company. All my data from my investments has shown that if I do more than 2 angel checks into a business, the likelihood is that it is going to eventually fail, because it hasn't reached escape velocity, and it's too easy for angels to sit there going, "Oh, it's just this bridge." In the past, I would have, and I've looked back at the spreadsheets, and one company I did 5 angel checks into. That wouldn't happen today. Maximum I would do is 3, and I've set a cap on the amount of money that I will invest until it gets to profitability.
That's quite a counterintuitive one for many people, because you see a lot of angels going, oh, it's a down round, it's a better valuation, more opportunity, they must have learned their lesson. But I think your data and our own data shows that those companies, even the ones that are doing flat rounds, haven't hit the velocity that they need to go on to be successes. So with the Access Fund, we won't do flat rounds or down rounds.
I've definitely been guilty of doing down rounds in the past. But if you have an idea about how much you want to invest into a particular company, then that's a good guardrail for you. And like I said, more than 2 rounds is probably not a good indicator of success.
No, definitely. Question number 3.
Mm-hmm.
Do you have an end game in sight for your angel investing, or do you think it's going to be another 25 years?
I actually had an idea that I was going to retire at 50 from angel investing. I'm long past that. And as my brother loves telling me, you're doing more deals than ever. So I look at this in very, very practical point of view. I'm getting older and entrepreneurs are staying the same age. And there's going to be a point where they're really not going to want to listen to a grumpy old man telling them what I think they should do. So I think the market will decide when it's time for me to bow out. I fundamentally really enjoy what I do. I'm lucky enough to make money out of what I do. And I think the third most important thing for me is about having control over my diary. So whilst I still have control of my diary and I can do what I want when I want and still be really involved in young and exciting companies and entrepreneurs who are really trying to make a difference and build new and exciting businesses, I think I will continue just doing that.
And I think you should, because we very much enjoy co-investing with you. But it's been absolutely a pleasure having you on the show. You did mention before that you post regularly on LinkedIn. For anybody who wants to stay in touch, learn from you, what would you suggest that they do?
Please just reach out to me on LinkedIn, follow me. I get a lot of approaches every day, but if I can help and if you've got specific questions that you want just to ping through to me, I'm fairly responsive and I will try my best to answer them.
I don't think anybody can ask for much more than that. So one last time, thank you so much for joining us.
Thank you for having me.
I do hope we can do this again in 12 months and we can make it an annual. What have you seen this year?
We could talk about the deals we've done together.
Yeah.
Because I think a few of them are already beginning to look quite exciting.
They are indeed.
Yeah. We could kind of delve into the nitty gritty of particular deals and what makes them tick.
I would love to do that. So thank you again and have a lovely rest of your day. We will speak soon.
Thanks very much.
Well, that's it for this episode of Angel Insights. I do hope you've enjoyed learning from Simon as much as I have. As mentioned, you can find out more about him by going to LinkedIn and searching for Simon Blakey. And if you want to learn more about us and what we do at SyndicateRoom, please head on over to www.syndicateroom.com. I do hope you will like and subscribe and tune in for the next episode. Look forward to seeing you then.